This is a separate announcement from our ratings business. The announcement the other day was from our indices business, and that continues a long stream of sustainability indexes that we've been implementing over time. But this is an ESG evaluation that is a forward-looking evaluation of a company's preparedness with respect to environmental, social and governance risk.
Right.
And it leverages our analytical teams, expertise in sectors and regions, and it also includes an interview with management and a board member in order to really get underneath what is going on in the company with respect to ESG.
And it's driven on both sides. So there's investor demand, as we've discussed and as we hear about all the time for this. There's also company demand. So what you guys are doing is similar to the ratings business model, where you might assign, a level of investability or, I was going to say junk, trying to use the nice word, high yield. The companies pay for those ratings. So again, in this case, the companies are going to come to you, ask for this rating, pay for that, and then this operates much like the bond ratings business, right?
Well, this is not a credit rating. It's a different analysis, because it really is looking at how a company is dealing with all of its stakeholders and the impact that the company's relationship and impact on its stakeholders can have in terms of a rebound back on the company, be it positive or negative. So we're looking at it through a very different lens from the lens that we look at in a credit rating, but it's a similar model in the sense that we will have a meeting with the company and discuss these issues with the company.
Do the companies have to come to you and apply to get this rating? And if they apply, what if anything, do you charge them?
Well, I can't talk about what we charge them because my role is analytical and I don't look at that. But the companies do come to us and say, we would like to go through this evaluation service.
So they will pay. They will pay to receive this rating.
They will enter into some sort of contractual arrangement with us to receive this score. It's not a rating, it's a score between 1 and 100. And it looks at, first of all, there's a risk atlas which allows us to align the starting point of each industry and region across the world. Then we look at the company's profile, and we look at 12 factors in that profile which really dig into environmental, social and different governance indicators. Beyond that, we then sit down with the company and review the profile assessment, and the profile assessment has drawn on public and private data. And then what we do is we talk to the company about their preparedness for the future. As we know, companies are facing a lot of different challenges in their business model over the medium and long term.
I don't mean to be belligerent. I do mean to be persistent on the matter of payment, because as you will well recall, one of the things that was called into question years ago with respect to bond and credit ratings was that companies had to pay and pay a lot of money in some cases to receive those ratings. You answered my prior question about whether they would pay, that the applicant company will enter into a contractual agreement with you, S&P Global, for that. Is it involved money? You get paid? I mean, that's what I'm asking. It's pretty simple, yes or no.
We have a very strong line between the analytical role and the commercial role, and I sit on the analytical side, so I really can't answer that question. I'm sorry. You'd have to ask someone who sits on the commercial side about that question.
Okay, we'll do that.
I have an analytical question then.
Thank you.
I'm not sure if you can see this, Susan, but we have on the bottom of the screen, new way to rate performance, sustainable investing. Should investors care? So my question to you is, should investors care? Is there data that shows that companies that score well actually perform better over time?
There's been a lot of analysis done on this, and the biggest analytical study that we've seen does show that there is a link between the performance of a company on ESG overall and its performance overall. I think the issue that we have today is there are a lot of benchmarks, there's a lot of data, the data is incomplete, and in many cases it's hard for the company's full story to be transparent to an investor. And what investors are really trying to do with ESG is they're trying to understand what other information they can glean on the company beyond traditional financial analysis to look at how the company can deal with the challenges that it is going to face over the short, medium and long term. And that's what our analysis does, because it's not just a short-term focus, it's not just relying on historic data, it's based on a full discussion with the company, a full look at all of the ESG factors, and a focus on how they can either deal with these issues or address these events or catastrophes going forward.
I hope you don't think we're all belligerent here and that we're simply persistent.
Only me.
But I'm still confused. If I invest in companies that score well on ESG over time, and you can pick any time frame you want, am I going to do better than just putting money into an S&P index?
Well, I don't. The other thing I don't do is provide investment advice, but I suppose what I can say is what our tool provides, or our analysis provides, is the capacity for an investor to say, I really care about these factors, so I'm going to look to how well this company scores in these factors and take that into account in my investment decision making. But that's up to them to decide what they want to look at and how they want to take it into account in their investment decision making. What we do know is that the lifespan that companies have on the S&P 500 has dropped dramatically over the last 50 years, because companies are facing more and more challenges.
Right.
So we've got technological risks, we've got technological change, we've got disruption, we've got consumer pressure, we've got social media, we've got changing regulatory environments. And what we're really trying to get at is how well equipped are companies to deal with these changes, and how is that going to impact on their performance in the future? And to the extent that they're not dealing with stakeholders, what impact is that going to have on the company?
Susan, thank you. Susan Gray.